Folks, I hear it all the time. People think investing is some secret club. They think you need a fancy degree and a pile of money just to get in the door. That is just not true. It's a myth sold to you by people who want to make things sound complicated so they can charge you big fees. I'm here to tell you that you can do this. A little bit of common sense, a willingness to learn, and you can build wealth. Whether you're starting with $100 or $1,000, the journey of 1,000 miles begins with a single step. Your journey to financial peace can start today with that first dollar you decide to invest. So what is a stock? A small piece of ownership in a company. Buying a share. Buying a tiny slice of a business. If the company does well, your slice can go up. If it struggles, the value can go down. Like owning a sliver of your favorite coffee shop, or the company that made your smartphone. You're betting on that business's future. This isn't gambling when done right. It's partnering with great companies. Benefits are clear. Your money starts working for you, not sitting in a bank getting eaten by inflation. It's out there, growing and compounding. Einstein called compound interest a wonder, and he's right. It's the snowball effect. A little now, given time, becomes a lot. This builds real, lasting wealth. It can change your family tree and put you in control. But there's another side, risk. I won't lie. The market goes up and it goes down. That's its nature. You can lose money, especially if you panic and sell. The key is understanding risk, managing it wisely and focusing long term. Over time, the market tends upward. People who get hurt chase quick riches. We're not doing that. We're building slowly and steadily, like laying bricks one at a time. Before you even think about investing a single penny, you have to get your own financial house in order. You cannot build a strong house on a shaky foundation. The first step, always, is to save up a starter emergency fund. I'm talking about $1,000. $1,000 emergency fund. This is your buffer against life. When the car breaks down or the water heater goes out, and it will, you won't have to panic. You won't have to sell your investments at the worst possible time just to cover an unexpected bill. This little pile of cash gives you peace of mind. It protects your investments so they can do their job and grow. Once you have your $1,000 starter emergency fund, it's time to attack your debt with gazelle intensity. Get angry at it. Pay off debt, credit cards, student loans, car payments, the works. You have to get these weights off your back. Why? Because the interest you are paying on that debt is a guaranteed loss. A credit card charging you 22% interest is a 22% hole in your financial boat. There is no investment on Wall Street that can reliably promise you a 22% return. To cancel that out. Paying off debt is the best, most certain investment you can make. After the debt is gone, you need to finish building your full emergency fund. Full emergency fund. This means saving up 3 to 6 months of your essential living expenses. This is your real insurance policy against major life events, like a job loss or a medical issue. With a fully funded emergency fund, you can weather almost any storm without having to touch your long-term investments. This step is what separates the grown-ups from the kids in the world of personal finance. It provides the stability and security you need to invest with confidence for the long term, knowing your immediate needs are completely covered. Only after you have your full emergency fund in place are you ready to start investing. I know you're excited to get started, but please, hear me on this. Do not skip these steps. I have seen thousands of people try to jump ahead, and it almost always ends in heartache. They get an unexpected bill, have to raid their retirement accounts, and end up right back where they started, only with less money and a lot more regret. Follow the plan. Be patient. Building wealth is a marathon, not a sprint. Get your foundation solid, and then you can start building the skyscraper. A Roth IRA, a standard brokerage account. An IRA is an account for retirement savings. The Roth part is what makes it special. You put in money you've already paid taxes on, it grows over time, and when you take it out in retirement, it's tax-free. That is a huge deal. A standard brokerage account is more flexible. Think of it as a general-purpose investment account. You can put money in and take it out whenever you want, though you'll pay taxes on profits when you sell. Good for non-retirement goals, like saving for a down payment on a house in 10 years. For a beginner with $100, a Roth IRA is almost always the best place to start. The tax-free growth is a gift to your future self, and it will keep on giving for decades. Where do you open one? It's easier than ever. You can do it online in about 15 minutes. Brokerage firms are the companies to use. Look for well-established firms with long track records. Fidelity, Charles Schwab, Vanguard. They're like department stores of investing, huge selection of options and very low fees, sometimes zero fees to open or trade certain funds. Do a little research, pick one that feels right, and follow the simple steps on their site. When setting up, you'll need basic personal info, your social security number, and your bank account details to transfer money. It's straightforward, like opening a bank account. They'll ask about your financial goals and your comfort level with risk. Be honest, this isn't a test. Once the account is open, transfer your first $100 and get ready to make your first investment. You've opened the door to your future as an investor. It's a big step. Be proud. You've got your account open, your $100 is sitting there, ready to be put to work. Now the big question, what do you actually buy? This is where a lot of people get paralyzed by fear. I want you to forget all that noise. You are not trying to pick the next hot stock. That's a fool's game. Instead, we are going to use a simple, proven strategy. Diversification. That's just a fancy word for not putting all your eggs in one basket. You want to spread your money out across many different companies. The easiest way to do this is by buying something called an index fund or an ETF, exchange-traded fund. Think of an index fund as a big basket that holds small pieces of hundreds or even thousands of different companies. For example, an S&P 500 index fund holds stocks from the 500 largest companies in the United States. When you buy one share of that fund, you instantly own a tiny piece of all 500 of those companies. This gives you instant diversification. You're not betting on one company to succeed. You're betting on the American economy as a whole to grow over time. I recommend good, growth stock mutual funds with a long track record of success. Specifically, I like to see people spread their money across 4 types: growth, and income. Aggressive growth international. This gives you a healthy mix of large, stable U.S. companies, some more aggressive, faster-growing companies, and exposure to successful companies from around the world. You don't have to get all 4 with your first $100, of course. A great place to start is with a simple, low-cost S&P 500 index fund or a total stock market index fund. It's a solid, simple, and effective starting point. Remember to pay attention to fees. Every fund has something called an expense ratio. This is a small percentage that the fund company charges each year to manage the fund. You want this number to be as low as possible. Look for index funds with expense ratios well below 0.20% or even lower. It might not sound like much, but over decades, high fees can eat away a huge chunk of your returns. Low-cost index funds are the smart, boring, and incredibly effective way for beginners to start building wealth. Choose a good one, and you're on your way. Let's make this crystal clear. Here is a simple, actionable plan for your first $100 and for the money you'll add after that. We're going to keep it straightforward so you can take action today on October 13th, 2025. No more excuses, no more waiting. The goal is not just to invest this one-time $100, but to build a habit of consistent investing. That habit is far more important than the initial amount. It's the small, steady contributions over a long period of time that build massive wealth. This is about process, not perfection. Here's your plan. Step 1. Open a Roth IRA with a reputable, low-cost brokerage firm. We talked about this. Get it done. Step 2. Transfer your $100 into the account. Step 3. Use that $100 to buy shares of a low-cost, broad-market index fund. A great choice is an S&P 500 index fund or a total stock market index fund. They are simple, diversified, and have historically performed well over the long run. Don't overthink it. Just pick one and make the purchase. You are now officially an investor. Congratulations. Step 4. Set up an automatic transfer and investment. Decide on an amount you can consistently invest every single month. Maybe it's $25, maybe it's $50, or $100. The amount is less important than the consistency. Have that amount automatically pulled from your bank account and invested into that same index fund every month on the same day. This is called dollar cost averaging. You're buying whether the market is up or down, which smooths out your purchase price over time and takes the emotion out of investing. Step 5. Leave it alone. Don't check it every day. Don't panic when the news shouts that the market is falling. Your job is to ignore the noise and stick to the plan. Your automatic investments will keep chugging along, buying more shares month after month, year after year. Your job is to live your life, stay on budget, and let your money do the hard work in the background. That's it. That is the entire plan. It's simple, it's boring, and it's how you become a millionaire. As you start this journey, it's just as important to know what not to do. I've seen good people with good intentions make some common mistakes that set them back for years. The biggest mistake of all is trying to time the market. This is when people try to guess when the market will hit its lowest point to buy in and its highest point to sell. Folks, let me be clear. Nobody can do this successfully over the long term. Not the experts on TV, not your brother-in-law, and not you. People who try to time the market usually end up buying high and selling low, the exact opposite of what you want to do. Another huge mistake is putting all your money into a single stock. Maybe you work for a company and love it, or maybe you just heard about a sure thing from a friend. This is not investing, it's gambling. Even the best, most solid companies can run into unexpected trouble. We've seen corporate giants fall from grace overnight. If all your money is tied up in that one company, your entire portfolio can be wiped out. That is why diversification through mutual funds or index funds is so critically important. It protects you from the failure of any single company. Panicking when the market drops is another classic blunder. The stock market is volatile. It will have down years. It's a normal part of the cycle. When this happens, your account balance will go down, and it can be scary to see. The amateur investor panics and sells everything, locking in their losses. The wise investor does nothing, or even better, sees it as a sale and continues to buy more shares at a lower price through their automatic investments. Remember, you're in this for the long haul. Short-term dips are just noise on the path to long-term growth. Finally, don't get sidetracked by shiny objects. You'll hear about all sorts of new and exciting investment opportunities: cryptocurrencies, NFTs, day trading, penny stocks. These are not investments, they are speculations. They are get-rich-quick schemes dressed up in fancy new clothes. The path to building real wealth is slow and steady. It's boring. It's about discipline and consistency, not about finding the next lottery ticket. Stick with good, solid, boring mutual funds and index funds, and you will win with money over the long term. Avoid these common mistakes, and you'll be miles ahead of most people. We've covered a lot of ground. We've talked about getting your financial house in order, choosing an account, picking your first investment, avoiding common pitfalls. It might seem like a lot, but it all boils down to a few simple principles. Live on less than you make. Get out of debt. Invest consistently for the long term. Be patient. This isn't rocket science, it's common sense. The power is not in secret knowledge, it's in your behavior. Make a plan and have the discipline to stick with it, month after month, year after year. That first $100 is more than just money. It's a declaration. You're telling yourself you are taking control of your financial future. A vote of confidence in your ability to build a better life for you and your family. Every dollar you invest is a seed. That seed becomes a tree that will one day provide shade and security for your future self. Think about where you want to be in 10 years, 20 years, 40 years, worried about bills, or living with financial peace, able to be generous, enjoying the fruits of your labor. The choices you make today determine that reality. Imagine yourself decades from now, looking back on this day, October 13th, 2025. You'll remember it as the day you decided to start, the day you took that first, small, courageous step. You won't remember the daily ups and downs of the market. You'll see the incredible growth over time because you were consistent. You started small and were faithful with what you had. It grew into something magnificent. Your future self is cheering you on. Don't let them down. Here's your call to action. One clear task: Don't just read this and file it away. Take action. If your foundation is in place, go online, open that Roth IRA, and invest your first $100. Do it today. The best time to plant a tree was 20 years ago. The second best time is now. Stop waiting for the perfect time. It will never come. Start where you are, with what you have. Your journey to becoming an investor and building a legacy starts right now. You can do this.